Well, good afternoon, everybody, and welcome to our webinar today on taking the books from compliance to tax planning. I'd like to thank all of you for taking the time out of your day to join us. My name is Brad Hull, and I'm a Business Development Manager with Intuit Canada. Some of you out there might recognize my voice. If we know each other, hello, good to be here. And our webinar today is being presented by Susan Watkin. And Susan is the owner of Watkin Small Business Services, an accounting, bookkeeping, and small business education firm in Southern Ontario. So in her business, Susan specifically works as a strategist for startup business, a financial analyst for growing businesses, and as an onboarding specialist. She's a determined educator and enjoys working with fellow professionals and business owners, educating about accounting, taxation, and business practices. Susan is also proud to be a member of both the Intuit Accountants Council and the Trainer Writer Network. So good afternoon, Susan.
Good afternoon, Brad. Thanks for having me.
Oh, thank you for being here. We appreciate you joining us to present on this very important topic for a lot of people out there. So just a couple of, or one quick housekeeping point for all of the attendees. Susan is willing and ready to make this somewhat interactive session. So on the right-hand side of your screen, you will see an option for questions. So you can type a question into there, and I will take care of bringing those to Susan's attention to be answered as we go through the webinar. Sound good, Susan?
Sounds good. Yes, I'm just turning on my web camera so you guys can actually see me. I'm going to see if some technology here.
Hello.
I'm not very technical. Sometimes this stuff is, I'm just trying to look for me. Okay, as long as you guys can see me, that's good. I can't see me, so there we go.
Oh, you are right there. Good. Hello.
All right, good.
Well, Susan, I will turn it over to you.
Perfect.
Yeah.
All right, well, thanks so much, Brad. Thanks so much, Intuit, for having me do this presentation. I enjoy doing this very much. So welcome, everybody, and thank you for joining me today online to talk about taking the books from compliance to tax planning. This is the agenda that we're going to kind of go through today, and for the purposes of this presentation, I have split the talk into two sections, and so where we have advisory and the sole prop partnership, and then advisory and the corporations. And I see this thing is still sitting up here, and I apologize for that. There we go. What I'll be touching on today is by no means an exhaustive list of what you can do, but the idea is to help you get started and to perhaps consider some of the things that you could be offering to your clients. And I'll do my best to stay on time target, but there's a lot I want to cover, and I don't want to speak too quickly. Okay, but like Brad said, ask questions. If there's something I touch on that you want to know a little bit more about, please pop it in the question box, and Brad will bring it to my attention, and hopefully we'll address it right away. So, all right, well, let's get started, everyone. Okay, so the presentation today is about how we are using the data we are creating and collecting through our bookkeeping for our clients and taking that data to the next level, such as tax planning. So whether you do the full bookkeeping for a client or just review the books once or twice per year, there comes a time for every client that all that work is used for completing income tax returns or for providing advice for them on their business operations. And as we know, as accounting professionals, every line of data that we are using in the day-to-day compliance will be used at the end of the fiscal year to determine that business's financial position and its tax obligation. So the opportunity that we all have here now is to plan throughout the year, prepare our clients for income tax time so that they're prepared and have a full understanding of why their business is where it is. Okay. We can take this information as well then, and we help to create and turn it into something that is impactful for our clients and for their business, which is really important, and then just kind of escalates the level of service that we're giving to them. All right. Just a couple of housekeeping notes. I'm going to add this in because in case any of you noticed, this is because you can see me, I can't obviously see you. And just so you know, I have my notes in front of me. So if you see me flicking up and down, it's just because I'm trying to stay on target with what I wanted to talk to you guys about today. So number one, right, if you don't understand what is going on in the business, how can you advise on that business, especially at tax time? So for those of you that don't offer tax services, this doesn't mean this isn't helpful for you, not at all. You know, what this does is help you lay the groundwork for your ongoing advisory services and expertise and planning for your clients. This is not just related to only people who prepare taxes. Please don't think that. So what about those of you or those other professionals that are only doing the tax work? They're not doing the bookkeeping. Well, this is your opportunity to extend your advisory services and perhaps improve your client relationships, right? The reality is, what my opinion is, the reality is how can you effectively advise a client on their income taxes, help them plan for it, or help them plan for any stage of the business if you are only looking backwards in time, right? So instead of looking ahead. So what the point is always this, you know, what's coming up, what's going to be happening, right? So this doesn't mean, please don't get me wrong, this does not mean you're not giving good advice, not at all. It's just if you're only reviewing it at year end or at tax time, just think about how much more it could mean to your client if you were engaged more often. You know, if we want to think proactively, right? Not the reactive, right? So no one wants to know what they should have done. We want to know what we should be doing, right? So this is something that, you know, if we stop and we take a look at our own businesses, you know, we would think, well, yeah, thanks for telling me, right? You know, when something is hindsight is 20/20. So we want to put that, and we want to put that onto our clients and the relationship we have with our clients, and help them get to where they want to be with, you know, with their business, right? All right, so going from compliance to planning doesn't and shouldn't happen just at the end of the year. You know, so throughout the year, when considering a set of books for review, you should really be asking yourself 4 questions. And these, of course, this is my opinion from my years of expertise, but these are the questions that I feel that we as accounting professionals need to be asking of all of our clients. So the first is, well, what type of business is it? And by asking ourselves that, you know, what are its tax obligations? You know, is it a sole proprietorship? Is it a partnership? Is it a corporation? Is it a nonprofit? You know, because as we all know, each type of business like this has different tax and operational obligations and expectations. They probably have guidelines that's going on in their business. They have different shareholders. So we need to understand before we can really advise anybody based on what the bookkeeping that we're doing, we have to understand what is the corporate structure and what are the expectations, what are the business structures, right? So, and depending that, you will have to, you know, basically you'll have to tweak what you're looking at, you know, it might mean and what it might mean for that business. So there's many similarities. Most companies want to understand the same types of things, you know, money in, money out, what are we earning, you know, how much do we have to spend, how much, you know, can I budget for? But when it comes to some of the more high-level tax planning, this isn't a one-size-fits-all. So we have to understand each type of business. So if you're working with these, if you're doing the bookkeeping, then you presumably already do understand this. So, and then that next level, and this goes for all of us, even if you're not doing the income taxes. Like I said, this whole compliance to tax planning isn't about all of us that do tax prep. This is just about us offering services throughout the year to get them to that point. So even if you're not doing the taxes, do you understand the obligations for that type of business structure? Because think about what you can help for them throughout the year, you know, in preparation of that, you know, their income taxes. Okay, next, how often are you in touch with the bookkeeping records? You know, are you accessing them weekly? Are you looking at them monthly, quarterly, yearly? And the reality is that why I ask this is this a good enough? Is this enough time for you to get a really good picture in order to plan? So, you know, we all have, as accounting professionals, we all have our own way of working with our clients. And for myself, in the accounting division of my corporation, we find that the longest that we can go without quote unquote touching a client's file is quarterly. You know, this is a minimum quarterly review, you know, and we can be assessing the past quarter, all while we're looking ahead to the next 1, 2, 3 quarters coming up in the year, you know, and this is a part of our planning and advisory services for, especially for our clients that are looking to grow. But for us personally, if we won't work with a client really that doesn't want us to look at their books, because it's not the relationship that we're looking for, right? And I have worked in the past with clients that only have us touching their stuff at tax season, and we're not doing the work, we're not doing the reviews throughout the year, and I have found these to be the most unsatisfying client relationships. And I think that's on both sides. And it just isn't enough time for us to really understand that business and to be really effective for them and have a value to them, because they're not seeing what we can do for them throughout the year. The third question is, do you understand your client and their business goals? Like, what are they trying to accomplish this year? Are they planning for growth? Do they want to be selling this company? You know, and regardless of the role that you have in your client's organization, whether you're doing CFO work, bookkeeping, you're just accounting support, you should have a general understanding of where that, sorry, I think this is jiggling. Where the client is going, what their main goals are, what their mission is, because as you work on their file, if you have that understanding in the back of your mind, then if something comes up, then you can, you know, you'll be able to catch that. You can offer that this little extra tidbit of advice for this client. You know, okay, you know, we got to watch for this come tax season. I noticed that, you know, you guys were planning to do this, and this is coming through. How can we keep an eye on this? And I have found clients that I work with in this exact way, that they're really appreciative, really grateful of us doing this proactive work, not having to ask, you know, so you're really becoming a part of their organization and not just somebody on the periphery, right? Okay. Next is, we've got my last of 4 is, how does your software stack up? You know, how does is your software working for you to enable you to be this advisor, enable you to take those records, the compliance, be able to look at it, manipulate the data, you know, get them the information that they're looking for in order to plan and prepare for tax season, right? So you want to, you know, some of us, if they want us to be looking at more often, you know, we have to deal with online services because we have to have quick access for the clients, you know, and for our tax, you know, for taxes, we want to have the software that's working for us so we can, you know, we can input some, you know, general information so we can do some samples to see, kind of test where things are standing right now. What kind of implication do the books have right now based on what we see? So making sure you have the right programs, the right software for you to really be able to deliver on your advice for them is definitely key. Okay, so now that we've asked ourselves those questions, let's dive into the more common compliance, advisory, and tax planning issues for sole proprietors. As I said at the beginning, I was going to kind of split it up to kind of keep them separate, you know. So the number one thing, obviously, for planning and looking at the compliance work to tax planning with a sole proprietor is making that decision of, is it time to incorporate? You know, many clients are asking us this, and this is something that requires a significant amount of review, of research, right? So as you're working on the bookkeeping throughout the year, you know, you should be looking at the bottom line, of course, but not just for the profits and losses, you know, but you want to see if business is getting to a point where incorporation would be the most sensible option. Okay, so now making that decision is ultimately the choice of the business owner. But as the accounting advisor, you know, if we're looking to give them some sound tax advice, and we need to look at how the profitability of the business will impact even the owner at tax time, right? Because as you know, there is no difference between a sole proprietor and their business and their personal income taxes. So they impact each other. And sometimes what we like to look at is when we're looking at the profitability of the sole proprietorship at this time is, you know, would the incorporation lead to a significant savings in tax liability for them personally? And would those costs of incorporation be outweighed by the savings? Okay. So some things to consider that are not just what's going on right now in the business, as honestly, like I said, that's reactive looking, that's done. Those sales are made, they're under them personally, but we need to look ahead. So does this business owner project continued sales like they're currently making? Or perhaps they think that they've peaked, perhaps in the coming year, they project a loss rather than an increase in sales, so ultimately incorporation, even though this year, the sales looked good and might have made sense for them, next year they're reducing the amount of work that they're going to be doing, thusly having significantly less revenue. So maybe, we're going to put that off again another year. But on the other side, well, maybe they think that they're going to anticipate a significant growth in their business. So then this might be a consideration before they see that huge influx of revenue. We want to get that under the corporate tax rate, to kind of help save them with that tax burden. Excuse me. By reviewing the bookkeeping ongoing throughout the year and understanding their goals and their projections, you can plan with the business owner when incorporation will make the most sense. Now, it's going to take work to show the client at what point their bottom line will affect them in such a way that that the personal tax rates, it'll no longer make sense for them to keep this under as a sole proprietorship, but it's well worth the conversation and the work for the benefit of that business. Because trust me, people, if you've never experienced this with a small business, they really appreciate it, obviously, when you come to them and say, this is going to save you a lot of money, if that's the way it will work out for them. And one thing I like to say is that there is no magic number. I have people ask me all the time, when should I incorporate? How much do I need to be making? What are my sales? And I say there's no magic number, because you could ask a dozen accounting professionals and each one of them is going to say, well, I would recommend it at this stage, or I would recommend it at this stage. What I personally think I like to do is I give the client the tax liability information based on their books. I'm going to break it out to them and say, okay, well, this is the impact that it's going to have on you personally if we leave your business operating as a sole proprietorship. This is where we're going to see taxes if we continue as we've been going. And then on this end, if we incorporate now and we proceed this way, this is where it's going to be, the impact is going to be felt, So what I'm doing is not telling them, because as we know, clients are very, they want to be, they're relying on us. So they're going to trust us if we say you're going to incorporate now. But what I want to do is I want them involved in this discussion, because they need to be making this decision, because it is their business. So I'm giving them the information to decide. And then they can make an educated decision, and then they can be happy for where the direction in which the business is going. And I like to think, like, what a great value discussion that is, for your clients. So, pardon me. The next thing I want to talk about with sole proprietors is considering things like when you're looking at their secondary income, or they have another business. And I giggle because I don't know how many of you do taxes, but if you have a sole proprietorship, I don't know how many of you have had times where they've come in and all of a sudden they say, oh, I have this other business, right? So these are all these things that you need to be considering for when you're tax planning with the main business, right? So they might have this side gig. They might not consider it much, but it is going to impact their business income, right? So also, if there's secondary income, do they have a job? Do they have a part-time job? So do they have insurable earnings? Do they have T income that's coming from another source that we need to consider in addition to, their statement of business activities, right? Also, you want to make sure you're understanding if there's a partner, if this is a sole proprietor partnership. So, and when you're tax planning with a partnership, if the partners, I have found, if they're not a married couple, it does take a bit more work. First, have both partners been actively involved in the business? Have both been providing what is needed for the financial records? And there's a surprising number of partnerships where the partners don't actually know what the other has been doing. And in many cases, one partner has left the full responsibility of the financial planning to the other person, right? So if you're only looking at this at the end of the year, then there needs to be the main question when you first see that person come in the door is, do they have everything? Have they received everything from that other partner or partners, right? Because remember, when you're filing taxes for a partnership, everything is stated in the T2125. So that's the statement of business activities if you're just getting into taxes now. And then it's split amongst the partners depending on the percentage of the share allocation, right, of the allocation of partnership. So if you need to understand what that other person has been doing, because quite honestly, it makes the most sense to be filing income taxes together, because then you're going to be able to plan where that business is going and prepare for both of them. I have situations where I'm only ever working with one partner, and that's fine. The other partner, they're provided the information, they can do what they want. So my focus is on working with my client, that partner, to make sure that, we can plan for their tax return as best as we can, irrespective of the other partner. Okay. So let's go next. And then we're going to have what we have. Obviously, we have the business use of home expenses, one of the key big benefit of being a sole proprietorship. And we want to plan for this as well. You're thinking, okay, well, wait a minute, this doesn't have anything to do with their bookkeeping. That's true. So what we do is, even though it's not actually belong in their bookkeeping records for their business, you still want to be planning and looking at this information throughout the year. Get your client to be actively involved in planning for this part of their income taxes, because if you're looking at this information throughout the year, this is also going to help you plan for that end of the year, because even though it's not a part of the business financial health, it is a part of the cost of doing business for this client. And as we know, for those of you who do taxes, what the bookkeeping says and what goes on the tax return does change. Okay, so it's important to have this information from your clients kind of ongoing, or make sure they're aware of it at least ongoing, because then they're planning for it. And then if you're reviewing their books, every 3 months or 6 months, then you can kind of take this into consideration as a little bit more information, just a little bit extra. I like to track it on a spreadsheet. I know, old school, but because it's a business use of home stuff, we track it on a spreadsheet. If you're using software, some people put it in the books and then take it out. However you do it, it's definitely a part of what you need to consider for their income tax returns. Okay. Now, I have fixed assets listed on the screen, but because fixed assets are something that apply to both sole proprietorships and corporations, I'm going to just touch on that in the next set of slides. Okay. And I think we are at the time, Brad, if you're still there, I think we're at the time for. Okay, well, great. So we're going to do a little poll, and we're going to ask a quick question, because I'm kind of curious, how often do you review your clients' bookkeeping records for the purposes of advising and planning? And I've got I've got 4 options there. Are you touching their books weekly? Are you looking at them monthly, quarterly, annually? So please take just a few seconds and fill that in. So that'll be pretty helpful for us.
Perfect. You can see the results coming in. Seems to be a pretty solid trend showing here. We've got about 3/4 of everyone out there have voted. Just a few more seconds here. I think we probably got, yeah, there we go. Perfect.
Great. All right, so what are we seeing here? So, okay, so we have a lot of us are doing this quarterly reviews, which is great. You know, I personally, I like that. That's the, like I said, that's the minimum for me, is looking at that. Honestly, it really all depends on the client, right? You know, it's what they want, what they're going to pay for, what their need is, right? So I have clients that, you know, they're expecting us to look at their books every week. You know, we might not be having a review meeting, but everything needs to be dealt with every week because they need to be making decisions. Everything's so tight that they need to understand where things are at every single time, every single week. So thank you all for that. That's awesome. All right, so then now, perfect. Now, I don't know, Brad, if there's any questions, if anybody's had a question, we can touch on that now. I'm happy to take a break and see if, I don't know, Brad, are you going to read out the questions, or I'm trying to find the panel.
So actually, we just had one come through.
Great.
So the question is, can we put home business expense and capital assets in the books and leave it there? Why do we have to take it out of their books if these are related to their business?
So, so obviously we're talking about a sole proprietor, and they are related to their business, but it's the business use of home expenses are external. You can put them in there, but I would highly recommend that you put them in based on the calculation of the percent allocation. So you're not going to want to be putting in their books their home hydro every month, because that's an incorrect representation of the expenses for that business at the end of the year. And this is, like I said, this is the other thing, if you want to be looking at this at a regular basis. So then you can, if you know 10% of their home is used for business, then sure, you can put 10% in. You just have to understand that when you're doing that, the tax return at the end of the year for a sole proprietorship, that those home expenses are not part of the standard expenses for operating the business. They are a total separate section. Okay, so you can put it in there for tracking purposes as if you want that information, but it's not a true expense that should be left really on the income statement, the true statement of costs for that business, because this is just a tax benefit that the government is allowing sole proprietors to do. You know, just make sure that if you're going to put them in there, change it to whatever the percent allocation that you were able to claim on the income taxes, not the full amount, because then it won't be correct. And just remember, it is separated. Capital assets absolutely should be in the books. That's a balance sheet, right? So any capital assets need to be booked. They need to be handled like you would any corporation, because these are fixed assets. So even a sole proprietorship, even though we don't report their income taxes, we don't report a balance sheet the way we would on a corporation, I believe that every business should have these proper financial statements, because they still need to see the health of their business. And part of that is looking at the balance sheet on a regular basis and monitoring fixed assets and their liabilities. So absolutely, corporate assets should definitely be there. Yeah, that's what you meant. Okay, I see it right now. Thank you. Okay, yeah. End of the year, definitely go back and add them and do your adjustments, and then they can see year over year what they've expensed. Consider like your year-end tax adjusting entries that you might get. So you're welcome. No problem. All right, so let me.
Just a reminder to everybody, if you have questions to ask, on the right-hand side of your screen, you should have a questions panel where you can just type them in, and we'll be happy to answer them for you.
All right, so then we'll move on. Oh, sorry, there we go. So now we're going to move into the compliance review and planning for the corporation. So this is the big stuff, right? So as I said at the beginning, there's stuff you're looking at that's similar on either side. You know, when you're looking throughout the year, whether you're a sole proprietorship, a partnership, you know, nonprofit or a corporation, you're watching that profit and loss, right? That income statement, because that's the bottom line is going to tell you, it's going to help you determine what the liability is. So what I'm going through here is not talking about specifically oh, they have a net profit of $5,000. What does that mean? What we're trying to do is we're looking at specifically within that, what can we watch for, and what's going to help us make some other decisions, not just the profitability of the organization. So, and now we get into, so as I said, the corporations. And it has the same issues as the sole proprietorships, but now that the business is its own separate entity, tax planning goes beyond just the individual. So now you have to plan for the corporate tax liabilities, and you have to plan for the shareholder personal tax liabilities if you are doing their taxes. Now, even if you're not doing their taxes, but you know them, and say this is somebody that went from a sole proprietorship to a corporation, these are people that, you're going to want to give them a heads up. If you do this with the corporation, this is how it's going to impact you personally. Excuse me. So now, because both of these are separate issues, but they need to be considered. So when you're reviewing throughout the year, it's something that you just want to kind of keep in the back of your mind. So the first one I'm going to talk about is the biggest conversation I have with most of my clients throughout the year, and that's something that we're always watching, right, is the salaries versus dividends. So unlike a sole proprietorship, when there's no difference between the business and the company itself, for corporations, there's shareholders. The shareholders have different ways of pulling money out of the company for their personal earnings. Okay, so if there's a shareholder that happens to be the owner, they'll most likely be more involved in this process versus a distant shareholder in a larger corporation. So for the purposes of this discussion, I'm focusing more on the owner managed business shareholder, if that makes sense. So when considering whether a shareholder should take a salary or a dividend and how it will impact both the corporate liability and the personal one, we need to decide where the priority falls. And this is where you have to be talking to your client. You have to understand what they're trying to do. And not just what they're trying to do in the business, but what are they trying to do personally, right? Where do they need to be? So I have clients that are always, I need to make sure I'm maxing out my CPP every year. I want money for the cottage, so it's like, what do they want to be doing? What do they need to be taking out the business? And then how are we going to handle that on the business side? So where you need to look at it is, so throughout the year, you should be monitoring this. So if most of us are doing this quarterly, it's great. You should be looking at, okay, last quarter, this is what we're seeing in terms of the revenue coming in, the expenses, where the bottom line is sitting. And now we really are managing a balance sheet and a proper income statement because it's a corporation and you have to. So you're going to look at that every quarter, and you're going to be thinking like, okay, should I be encouraging a client to take a salary, or are we planning for a dividend based on the trend that we're seeing right now? And you really have to look at it. It's where do you need to feel the difference, right? So where does it matter for the corporation? So if you're looking at that, there needs to be a reduction of income. They're making a ton of money. They don't have a lot of write-offs. So we want to bring that net profit down, right? So, well, that means we need to impact the income statement. So what's going to impact the income statement? Oh, sorry, just buying that. Well, that's things like salaries, bonuses, right? So we need something that's then going to hit the profit and loss statement. So that's one thing. Now, keeping in mind that as soon as you hit that, you're hitting an income statement, the way that's coming out, that's going to impact your client personally, right? So now if you're thinking like, well, they don't really need to reduce the bottom line, say they're running pretty good and, they don't need to bring that down, but they have a lot of equity built up in the business and they have a ton of cash and they're thinking, well, I really want to pull money out. So then this is where you might want to be considering a dividend. But again, this also impacts the client, the individual shareholder. So the process starts with looking at where is it better for the business, but just don't forget to think about how is this going to impact that person personally? Because as we know, NET income, so bonuses, salaries, that specifically, well, that has a higher tax rate going on them personally, depending on if they're getting employment income with their dividend will determine how much their dividend will be taxed, right? So you need to kind of have an understanding if that's what your client wants. If they're getting that done by somebody else, they have a financial planner, fine, but I think it's always helpful to give them the heads up. Yep, if you want to take a bonus, not a problem, just an FYI, you're going to get a T4 from this, which means you're going to have to pay tax. So let's make sure we pull tax off before you take the cash, right? So adjusting it in that way. So, and when you're reviewing this routinely, so with my clients, I do the quarterly too, and we have a couple of them that we're watching vigilantly because they just keep pulling money out, and that profit is going up, and we're trying to figure out, well, what's the best end result for them. So, and it's kind of nice every quarter they enjoy getting that heads up. I think we're going to have to consider doing this at the end of the year. So it's kind of planning ahead. Because especially if you decide to do bonus or salaries, don't forget their source remittances. And no matter when their fiscal year end is, those source remittances, when you've pulled that out, have to be done for the end of that current calendar year. Okay, so just don't forget about that. That's one of the big things. So again, you need to just consider where the tax burden can be handled better. All right, so corporate taxes versus personal taxes. All right, so that's part of your compliance before your tax returns. Next is the due to shareholder. Now, I bring this one up because I find this is kind of that catch-all account. Many small corporations still fall victim to paying for stuff personally, which they need to be reimbursed for, and conversely, many corporations have to use the corporation to pay for something personally out of need or just grabbing the wrong card, always. So then this account really ebbs and flows, right? So it's always going up and down depending on what the client is doing within it. And why you need to watch this is because depending at the end of the fiscal year, where the balance of this account sits is going to really dictate if you're going to have to do something with this. So if they're sitting there and they owe the corporation back, right? This is not a debt to them. This has now become their debt, depending on the balance. Well, you need to remember that this is something that has to be cleared up. There are rules with the CRA that how long, and right now it's a year. They have a year to reimburse the corporation for this debt. Okay, so this is something you need to watch out for. Did they have this debt last year? Oh, does that mean we have to, do a salary or dividend this year to offset the debt from last year, or, oh, wait, no, they wound up paying it back throughout this year, so we don't have to worry about that so much anymore. So these are the things why you have to watch this and monitor that account. Also, one of the things that I know that even with my own team is to be really going through this account on a regular basis. There's a lot of people I know that just, they don't know what it is and they just shove it in there. And these could be legitimate business expenses. So you might want to get into a habit with your quarterly reviews of getting that account listing to your client, or getting them if they're on QBO, saying to them, here, you need to go to this memorized report and I need you to review these transactions, because are these business? So then we can start reallocating them appropriately versus having this huge liability on their books that isn't true, right? Okay. So the number one thing is that it's really important to understand, the implications of what you're going, either way this is with this account, so if they owe money or if the business owes them, and what the corporate responsibility is on how to properly record this within the bookkeeping. Okay, so that's why we always say to keep an eye on this account now, and also keep an eye on the CRA regulations with regards to shareholder accounts. As we know, the government changes their rules. They change maybe the limits. So don't just go by what I'm saying, because next year they might say you got 6 months to repay this. So just making sure you're aware of this situation, because you're adding that extra value for your client. Okay. So now I'm going to go into, I apologize, hopefully I'm not talking too fast. The fixed assets for the sole proprietorships and corporations, because the reality is they are handled the same way. Capital assets are capital assets. Now, what we all understand is, did they buy anything this year that would qualify as a fixed asset or a capital asset? Is this something that we can write off fully, or do we have to amortize this? And many of our business owners, they're not familiar with how this works. So if they're in doing their own bookkeeping, what we've seen is often that they will post the whole expense thinking like, woohoo, I can write off a $15,000 car. And, and we know that this is not true, that they can't do this. So we need to be making sure that we're watching this, because they might be thinking by looking at their income statement that, well, I had this $15,000 expense because I bought that vehicle. This is great. Look, I don't owe any taxes. When the reality is that, well, that's a fixed asset. We're going to have to depreciate that over time, and you only get to claim this much every year. So, bad news, but at least the good news is that you're preparing them for this, and especially if you're not the one that's doing the taxes, because if this is somebody that they're taking their bookkeeping to somebody else, you don't want them coming back to saying, you never told me, or things like that, because, we know clients can sometimes do that. So being aware of their fixed assets, watching the expenses throughout the month, keeping an eye, or every quarter, keeping an eye of those big flag things. Is this something that, according to proper compliance, that we should be capitalizing? Is this a proper asset? And then taking care of that sooner than later, so that the client, if they're live in their books, if they're looking at their bookkeeping, well, then their profit and loss statement is going to be truly reflective of what they can expect on their income tax returns. You can also go one step further, and you can estimate what the depreciation will be for them, because you're going to know, you're going to know what the rates are. You're going to know what the percentages are there. You can do up a quick little calculator and say, well, we're going to be able to write off X. There's no reason to wait till the end of the till taxes are done to estimate that, because you know what it is. If you get you can get your schedules out, you can get your capital asset calculator out, and determine what they're going to be able to do it. And you can do it in advance of the income tax return. There might be an adjustment, when you actually do it in your software. But in general, it should be pretty close to accurate, which again is keeping those records up to date, so that when they're looking at them, they're looking at data that is true and is live. And you've done all this thinking for them. So you've gone and you've said, okay, well, I know that this is going to happen, and I don't want them to be shocked. That's, I think, the number one thing for clients that I've seen, is they're like, holy cow, I had no idea I was going to have to pay this much tax. Okay. Sometimes I'm a little bit like, well, you made a lot of money, so you have to, you have to know you're paying tax. But I feel it's our obligation as accounting professionals and accounting advisors is to give them just to give them a heads up. It's like giving them a little bit of notice before their HST is due that they're going to owe 20 grand, right? So it's kind of like a courtesy. I look back at myself and I think, well, what would I want to know? What do I want to know in advance? And then that's what I try to do the best things for myself, okay? This also goes to for if they're planning for purchasing an asset. So coming back to our goals, we're understanding, okay, he's looking to expand, which means he's going to be looking to buy a whole lot of equipment. He might be your client might be thinking, I'm going to write all this off. So you're going to want to just catch them in advance to say, okay, just remember, we don't get to write off the whole thing. Maybe push that to next fiscal year if you don't need it this year, or buy it now because we could use the portion of the write-off in this fiscal year. So it's really having that holistic view of your client's accounts, that on general understanding of what they're trying to do, and then a good understanding of where it's going to hit them when it comes down to their money. How much money are they going to have to pay, right? A few more things quickly. I'm just trying to watch on the time here. And so the next thing is, things to consider, because they're not in the books. They're in the books, but we have to put them back in the taxes. So any of you who do corporate taxes, you're going to understand this, specifically more so with corporate taxes. Add backs. Love those add backs. So you've got all this stuff that people are thinking, oh, great, I have $10,000 in meals I can write off, and I've got all these penalties, I've got all this interest. A lot of that stuff gets added back on the tax return. Okay, 50% of meals and entertainment, 100% of penalties, right? All those CRA penalties that they're getting for, failure to files or late arrears, that's not deductible. So even though you're posting it, we're posting that in the books because we're tracking the debts, we're tracking the liabilities and what's coming in and out of the bank. That all comes back. So when you're looking at that bottom line, you've got to add that stuff back in to give them a better representation of what they're going to be taxed on. So, and then estimating your liability. I like to calculate this relatively frequently. I do this with my quarterly, and I have a look at where they are sitting, throw some numbers back in, half the meals and entertainment, and then I just do a quick calculation on where their tax liability sits at this moment. Now, one thing I like to say to people is don't forget that once they hit over $500,000 in net profit, there's a different tax rate. So don't forget that. So don't charge it, calculate the whole thing on just, you know, on the one amount, but you want to make sure that if there's 500,000, you're calculating that excess at the proper higher corporate tax rate. Okay. And then lastly in this group is liability. So your loans, your debt, other obligations. And for this, consideration needs to be made for the payment of the debt versus the interest paid on it. So if these loans were for the purposes of earning income, so like buying equipment, expanding, then the interest is usually an allowable expense, okay? So if throughout the year, excuse me, the corporation's been making payments on this debt, make sure it's been recorded properly. Okay, so a lot of the debt payments are made up of principal and interest. Make sure when you're recording the payment that whoever, or if you or you've had somebody else or you're doing the taxes, did they split that out? Did we hit, you know, the loan and then the interest, you know, because we want to be able to, if it's an allowable expense, we want to be able to write off all of that interest. So this is, again, is taking that compliance, looking at what we've entered and making it better if we can, you know, for our clients. So now in most cases with some larger loans, like a vehicle or an expansion loan, a lot of times you'll get amortization schedules, which make this really easy. So you'll be able to put that in based on what the bank has provided for interest versus principal payments. Two final considerations that I'm just going to, yeah, are we busy? Am I run? Hello?
No, there was just a quick question from the material on that last slide.
Oh, sorry. Okay, yeah, I'm going to open that up. Sorry,
No
Brad.
problem.
It messes me up because I can't see anyone, so I feel like I'm kind of talking to myself most of the
all
time.
good.
So I can't even see you. Okay, so here we're going to look at, sorry, which one did you want to?
There was a quick question here. Can we adjust the books to reflect 50% of meals and entertainment, or would it be better to have it at 100% and adjust their tax only? Which way is proper?
Oh, well, proper, I'm not going to use that word proper. It's really your preference and your clients. So it's the same thing when you think about the HST on your meals, right? Because HST is supposed to be 50%. So do you record that at the time you're booking the meal and entertainment expense? So at the end of the year, you're only cutting meals in half and not HST, or do you just book the whole thing and cut everything in half at the end of the year? That is up to you and the client, because I have accountants that I work with that do either way. They book everything, full HST, full meals, and then they cut them both in half at the end of the year. There's an HST adjustment, and there we go. We do 50% half tax, but we record the full HST. So at the end of the year, we just cut the meals and entertainment in half. So our clients are seeing the benefit, at least, of the HST properly throughout the year. It's a preference. I've never seen a rule or a proper. I think this comes down to how it works for you and what your client wants to be seeing. I know a lot of my clients want to see what they're spending, and they care less about the tax at the end of the year. And then we have to remind them that half of that's coming back onto your income taxes. But for planning and budgeting purposes, they want to see that full amount. What are they truly spending? Because that transfers, remember, into your statement of cash flows, right? So that helps them with that type of planning. That's my personal preference, but I don't believe there's a right or wrong way, as long as that it's recorded in an income tax return properly. I hope that helps. So,
perfect. Thanks, Susan.
No problem. Thanks, Brad. Yeah, I don't have much more, so I'm going to keep plowing through. So the last two things I thought I would just really briefly mention these considerations: bonuses, auto usage. So again, just like we talked about at the beginning with salaries and dividends, is if you're considering a bonus in lieu of a salary or dividend, this is going to depend again on the health of the company and what the shareholders want, right? But again, and also don't forget that there's going to be the CPP, not EI if they're shareholders. So you want to plan for that as well if they're considering taking something. And then for the automobile, what we're trying to do is look at the personal use of the vehicle for the business. Now remember, there's this whole vehicle usage calculator in the income taxes. So they don't get to claim everything, right? So this is percentage usage. And this actually can come back to the same with what you asked there about the 50% meals. Is some people will put all their vehicle expenses and it all gets adjusted at tax time, which then gets adjusted for at the end of the year with an adjusting journal entry. Some people will just do a mileage allowance for their shareholder, so they don't have to worry about tracking that stuff. And this is specifically with regards to when the vehicle is not owned by the corporation. So I'm talking specifically just a personal vehicle used for business use. Okay, so you want to be making sure you've got those mileage logs. You've got are you booking the mileage, or are you going to do the percentage of the cost of the vehicle based on the mileage? So those are, again, things that you're going to want to think of, and either you do that quarterly. I like to keep that up to date pretty well, depending on the client, because otherwise at the end of the year, it's a lot to kind of get them to do. And I find if you're getting them to do a lot of this work every few months, taxes don't become this huge, big burden to them or to us, right? We don't want to try to remember, oh wait, did we get this? Did we get this? So that's the last thing I'm going to say about that type of stuff. And then, as I mentioned at the beginning, your software, do the applications you work with support the work you're doing, not just for the compliance, but that will allow you to take that data and turn it into something impactful for the client. Make this good, useful information for them to be running their business. So either saving them money or growing or meeting their goals, whatever they want to do. Are you using software that's going to give you the data? Obviously we're on an Intuit webinar and we're looking at, I've got, 3 of my favorite Intuit products up there. And it's, with QuickBooks Online, we can get all the information we want. We can do practice in, either whether using TurboTax or Profile, and now the new QB Pro Tax right out of QuickBooks Online. We have the software is allowing us to get that compliance information and get that information to our clients well in advance of tax time. So make sure you've got what you need so that it's less work for you, but you're more effective for your client. And that just makes you look fantastic, right? So I'm just going to say at the end of the day, as accounting professionals, you decide how you want to work with your clients and how often. There's no rules. This is between you and them. There's no judgment on my part. I just believe that reviewing the bookkeeping throughout the year does put you in a position to be that trusted advisor, to their business. You're creating a potential new revenue stream as well for your company. It gets you praise. It could get you referrals. And it's also the best way to deal with issues as they arise, because as I'm sure we've all dealt with, there's nothing like dealing with a problem at year end that happened 8 months ago, and so when we're looking at these things, we can help them reach their goals throughout the year faster rather than kind of going back and scrambling to kind of clean it up. So, and I find that clients that are actively engaged in their businesses are looking for professionals that are going to be the same, and that by being engaged regularly, you're preparing well in advance, and they'll feel better about the relationship. They'll appreciate the value more. So, and again, proactive, not reactive. It's just a slogan there, because we don't want to know what we should have done. We want to know what we should be doing. So help them understand what they should be doing, to just as part of your every day, if that's what you want to do with them, and help create that next level of a relationship with them. So, and that, I think, everyone, is it. So I hope that was helpful. And we have a few questions, so we're going to go through the questions now, Brad.
Yes, absolutely.
Yeah.
So there were a couple of comments that were made about the automobile charges.
Right. Okay, so I'm seeing here where the automobile is owned by the corporation, the expense considerations are different. Yes, they are. Yes, that's right. You've got your standby charges. You've got, you still have usage charges. You've got, you need to understand the personal usage. You need to understand the value of the book. It can be pretty complex. A lot of corporations will avoid that whole situation, and if they have shareholders that are just using their personal vehicles, they'll do vehicle allowances because it gets them away from that. But yeah, when it is a company, a corporate owned vehicle, there's a lot of stuff you need to you need to watch out. There's forms that people don't realize that they need to fill out. But yeah, thank you for bringing up that point, Natalie. It is something that we all need to watch out for. So just making sure you understand what you're doing. Obviously, you don't want to be giving advice if you don't fully understand the implication of what you're saying. And always, always check up with the CRA. Always the CRA. Don't just Google something and go to the first one and say, oh, that's great. Right from the horse's mouth. Go to the CRA website, find the guide, find the explanation, because then that is gospel, okay? And then the last one looks like Natalie said, what software do you use for projections? Well, I manipulate my QuickBooks data. So I like working in, when I haven't gotten into, I'll be honest, I get a little app overload. So there's so many applications out there that can do your project. Are you laughing at me, Brad?
I'm laughing because I hear that all the time, and I
Yeah.
experience it as well.
And I work with the handful that really work for me. So I take my information out of QuickBooks, whether it's desktop or online. I've got budgets within those software programs as well. So I run a ton of comparison reports, and I'm usually pulling those out into Excel to manipulate the data. And I just have some plain old tax calculator that I made up years ago that helps me take my numbers and spits me back out an estimate, right? So really, I made it very simple for myself, because the work, what they need from me is the advising. That is just a tool, right? So, and I think that was, oh, thank you for the positive comments, everybody. We appreciate that. So is anything?
So if anyone else wants to get a last minute question in, go ahead and just type it into the question box on the right hand side of your screen. I think we've got a minute or two left if there are
Yep.
any other questions. I was also talking about all the automobile expense stuff that you were going through there. Having been a commission salesperson for 25 years, I've had so many different ways of being reimbursed for mileage expenses. I know how complex that whole thing is. It's just crazy.
Well, and honestly, whoever you ask as well is going to tell you something different. You could even call the CRA 3 times and get 3 different answers. That's the frustrating thing. So to me, it's like I don't even call them anymore. I just go by, what does it say? What are the rules? And what's our interpretation, right? And as long as we can justify things and we can own that expense, and in most cases, the CRAs, they're like, okay, yeah, no problem. There's some clear-cut rules on what you should and shouldn't do. If that shareholder is considered an employee, well, they need to be, that's now a personal expense. That's a T777, right? So there's so many ways to look at these things. It's just about making sure that you just keep your eyes open for what's going on, what they're doing, right? So,
And there was
so
just
true,
a
yeah.
point here, agent interpretation is different from one to another. And yeah, we've seen that on the news too often even.
Well, and I'm going to put this out there for everybody. They do have a mandate within their organization, like it's written down. They are not allowed to give you their opinions or their interpretations. And if they do so, make sure to advise their supervisors. They're supposed to really just regurgitate the legislation, provide you the guide, the line, the paragraph, and that's it. They're not allowed to interpret the data at all. So the only guys you want interpretation from, just a heads up, is call the GST HST rulings guys. Those guys, those are the ones. But regular CRA, no, go with the guides, because it's all depends on, yeah, who answers the phone. So, but excuse me.
So Susan, there was a quick question here. Do you do any of our other webinars? I don't even know this.
Yeah, actually I do almost every one. You guys, I work a lot with Intuit. I work with almost every division of Intuit and I love it. I do the small business webinars, the Pro Advisor series. I work with the education division, and I do these ones, right? So I do quite a lot of webinars. So there's a bunch of really great links. If you know, I know, Brad, I don't know if you've got access to the links that you could post for people. There's those ones where they can get into the Pro series, the ones where we're talking about things like, you know, QBO conversions. There's other tax ones. There's tons of webinars that we do. So I wish I had the link at the ready, so I could put it in there. But yeah, if you know which ones I'm talking about. Yeah, there's a lot. If you Google quick Intuit education, Intuit Pro Advisor webinars, all of those, there'll be tons of webinars and you click on those. So I do a lot of those now. And yeah, but I appreciate the really positive comments. You guys make me feel really good. It's a lot, like I said, it's weird. I'm talking to space here. So so I'm always happy when it's receptive, and I like what I do. So I find that I enjoy passing on this information. So I'm glad everybody got a little bit of something out of it, and I hope it helps you. And hopefully I will see some familiar names in the next webinar. So.
Well, that's fantastic, Susan. Thank you very much for
You're welcome.
Presenting this. For all of the attendees, just two final points. Number one, reach out to your Intuit account rep to see if you qualify for a special offer that you might be able to receive for having attended this webinar. Ooh. And a plug for our next webinar, which is coming up on
hold on.
8th. Oh.
Sorry, I apologize. I was delinquent in my slide forwarding.
No problem at all.
Sorry.
So yeah, the next webinar is coming up on November 8th with Michael DeLauro on cross-selling your advisory and tax planning services.
Perfect. Yeah, that'll work well.
So I think that is it for today. Everybody will receive a link to the slides and to the recording of this webinar as well. So you'll have all of that information that you can reference back. And we hope to see all of you out at the next webinar. Thank you very much for joining us, and hope everyone has a wonderful day.
Yes, thank you all. Thank you again, Brad. Bye now.
Thank you, and bye.